So last time we started talking about derivatives and started talking about how we were going to price futures contracts. Now, if you recall, a futures contract committed you to some transaction at a future date. This week, we're going to start talking about options. And options, like the name implies, give you the right but not the obligation to carry out some kind of transaction. So like the name implies, with an option, you have an option if you want to carry out a transaction at a future date. So there's two main types of options. There's call options, and call options give you the right to buy, and put options give you the right to sell. And so the price that you can carry out this transaction is determined ahead of time. It's called the strike price. Typically, we denote that by K. So typically with options, K denotes the strike price. And then for the stock price, the price of the underlying, we use S. Now, there's a couple varieties of options that are typically traded. There's European options. So European options have a specified maturity date, and you can choose to exercise the option or not at maturity. Alternatively, you can trade American options. American options, you can exercise the option at any point before the maturity date. So American options give you the possibility of early exercise. There's also a couple of different exotic flavors of options, like Asian options or look-back options, and we won't spend that much time on those. We're going to focus mostly on pricing European and a little bit on American options. So if you recall, with futures contracts, the futures price was always going to be related to the spot price of the underlying asset. So the futures price was always going to be connected directly to the spot price. With an option, it's a little bit different because you have the option of whether to exercise or not, which means that the strike price, K, is arbitrary. And we can write options for a number of different strike prices. We can write an option for whatever strike price that we want. And we want to think about, well, if I have, say, a strike price of 100, and the current stock price, let's say, is also 100, then, well, depending on how the stock price moves from now until maturity is going to determine whether I want to exercise the option or not, right? Let's imagine I have a call option. If I have a call option and I have the right to buy the stock for 100, when would I want to exercise the option? Well, I would want to exercise the option if the price went up. If the price goes up, let's say the price goes up to, say, 110, and I exercise the option to buy for 100, I'm going to benefit. But if the price goes down, well, if the price goes down, that doesn't bother me so much, right? Because unlike with a futures contract, I'm not obliged to follow through on the transaction. I can simply decline the option and I won't suffer a loss. And so with an option, I always have a non-negative payoff. I can either exercise the option, and I would only exercise the option if it was profitable to do so, or I could just decline the option and get zero, which means that unlike with a futures contract, I'm never forced to suffer a loss with an option. However, what that means then is that options are valuable in their own right. If I enter into a futures contract, I don't have to pay anything for it now. But if I want to buy an option, well, I'm guaranteeing myself a non-negative payoff in the future if I own an option, which means that if I want to hold an option, I need to pay something for it now. So this is the option price. So if you look at the table on this slide, you can see that we have a stock that's currently priced at 162.51. And then we have strike prices that go from 130 to 190. The actual option chain for this stock, extends actually much further than this, but this is just a sample. And so what we can see is that for a call option, call options are more valuable when the strike price is lower. And that makes sense, right? Because if I want the right to buy something, I want to have that right at the lowest possible price. So if the stock is currently trading at 162 and I have a option with a strike price of 130, this will almost guaranteed to end up in the money, which means that I should be able to exercise it for a profit. Compare that with an option with a strike price of 190. Now, with a strike price of 190, this doesn't look that favorable, right? Because the stock price needs to close above 190 for me to want to exercise the option. So I only am able to get a positive payoff if the stock price goes above 190, which seems rather unlikely. However, the price is still positive because even if the price doesn't cross 190, I don't suffer a loss because I can just decline the option in that case. If I then look at the put column, what we can see is that with a put option, it's the exact opposite pattern. With a put option, I want the strike price to be high because if I hold the right to sell something, I want to be able to sell it for a high price. So a put option with the strike price of 190 is very valuable because then I'm going to exercise the option if the price ends up below 190, which is very likely. Whereas the put option with a strike price of 130, that's only going to be valuable if the stock price drops below 130, which is unlikely. However, once again, because I don't suffer a loss with an option, it's still going to have a positive price. So let's look at the formula for option pricing. So we use little t to represent the current time and big T to represent maturity. So this is when the option expires. So what matters for an option is the stock price at maturity. So with a call option, I'm going to think about, well, what are we going to do? CT is the price of the call option at maturity. Well, if the stock price exceeds the strike price, that means that the stock goes above the strike. Well, then I want to exercise, right? Because I want to exercise the call option. I can buy something that's worth ST for K. Of course, I want to do that. So my payoff, how much I gain, is ST minus K. If ST ends up below K, then I decline the option. If I were to exercise, I would lose money, which means that I'm not going to do it. So my payoff is just going to be 0. I can write this, and this is the typical notation used with options, as ST minus K positive part. So what positive part means, I take a look at what's inside the parentheses. If what's inside the parentheses is positive, then I take the value. Otherwise, the value is 0. So the payoff to a call option is ST minus K positive part. For a put option, well, I want to decline the option if it closes above K. And I want to exercise if it ends up below K. So the payoff to a put option, well, I'm selling the stock for K, so I get a payoff of K minus ST. This means that the payoff to a put option is K minus ST positive part. Now, one thing you might notice here is that even though these things are called options, you actually don't have much of a choice here, right? Whether or not you exercise the option is entirely determined by where the price ends up compared to the strike price. Even if you really wanted to hold the stock, well, you wouldn't exercise the option to do that here because you could just buy it on the market for ST. You wouldn't want to exercise the option, which would just force you to buy it at a higher price. So here you have a couple of payoff diagrams for options. On the left, you have the one for the call option. Here we have a strike price of 18.30. And on the right, you have the put option. So for the call option, the higher the price goes, the higher your payoff. So if the price ends up above 18.30, you get the difference between the final stock price and the strike price. But if the price ends up below 18.30, you just decline the option and get 0. If you look on the right with the put option, the lower the price goes, the higher your payoff. But if the price ends up above the strike price, then you decline the option and you get 0. So these pictures kind of give you a little bit of an understanding of why options are traded in the first place. With an option, you can capture all of the upside, right? If, for example, you buy a call option, then to some extent you're expressing a belief that the stock price is going to go up. Now, if the stock price does in fact go up, you'll benefit. And the more it goes up, the more you benefit. But if you turn out to be wrong and the stock price ends up falling, well, you can see that with an option, you don't expose yourself to any of the downside risk. If the price starts falling, then you just decline the option, and at best, you don't lose anything. So the last slide, we showed the payoff diagrams when you were taking a long position. So this is when you were buying an option. Here are the payoff diagrams when you're shorting an option, when you're writing the option. So if you're the option seller, then someone has the right to either buy from you or to sell to you. So if you are shorting a call option, then you're giving the option holder the right to buy from you at the strike price. And the option holder would exercise the option if the stock price ended up above K. Whereas for the put option, you're giving someone the right to sell to you, and they would exercise the option if the price ended up below K. So you can see that these are just the inverse of the payoff diagrams we saw for the long position. From what we've seen so far, it looks like options are kind of a no-brainer, right? You get all of the upside and you're not have to face any of the downside. So it seems like free money. Well, not quite, right? Because options, like we said, they have a price too. So, for example, if you look at the diagram, the strike price is 18.30, and the option price is 146.2. So you have to pay 146.2 to hold this option, whether you exercise it or not. Which means that if you pay money to hold the option and you end up not using it, you still suffer a loss. Yes, this is probably not as big of a loss as you would have suffered if you bought the underlying stock and saw it go down, but it's still a loss, right? So what we see here is that with a call option, because you have to pay to hold the option, if you look at your net payoff, right, which is the payoff from exercising it minus the cost of the option, you still need the price to go up in order to profit. So the price needs to go up by enough to cover the initial cost of the option. If it doesn't do that, and you end up declining the option, or you end up exercising it for an insufficient payoff, you're still going to end up losing money overall. Whereas, if you're taking a short position, well, if you're taking a short position, you collect the price of the option. So if you collect the price of the option, if you're writing an option, what you're basically saying is that you are betting that the option will not be exercised. So you're going to make a positive payoff as long as the option holder does not exercise, and they would need to exercise it for a sufficient gain for you to lose money. So options, like we said, are always going to have a positive value because you get all the upside and none of the downside. And we can break this up into two components. We have intrinsic value and time value. So if you look at the example here, we have a stock price of 162.5, a strike price of 160, and a call option that's worth 6.05. So the intrinsic value, we look at the difference between the stock price and the strike price. If we were to exercise the option now, how much would it be worth? By the way, we may not necessarily actually be able to exercise the option. Now, if this is a European option, we wouldn't actually be able to exercise it now. But let's just think about if we were, how much would it be worth? Well, it would be worth 251, the difference between the stock price and the strike price. So this option is in the money. It's not in the money by much, but it's in the money, right? The stock price is high enough such that exercising it right now would be favorable to you. So some of the value of the option comes from that. However, this intrinsic value is lower than the price of the option. There's another 454 that we haven't accounted for. So if this option is 250 in the money, why is it selling for 6? Well, the stock price is 162 right now. Right? So if we exercise it right now, we could get 250. If it went up by more, then we could potentially exercise it for more. If the stock price went down, well, we don't care so much about that because if the stock price goes down, we could just decline the option. So the fact that there is more time between now and maturity that the stock price could change is additional value that this option has. So this is called the time value. So the time value is saying between now and maturity, there is time in which the stock could move in the direction that we wanted. It could also move in the direction that we don't want, but because with options we're sheltered from the downside risk, we don't care about that so much, so the time value is going to be positive. If we look at another option with the strike price of 175 that had a price of 0.5, well, this option is out of the money, right? Because if we were to exercise it now, we would lose money, so we won't. That means the intrinsic value of this option is going to be 0, which means that all of its value comes from the time value. The price of the underlying stock could go above 175, and that possibility accounts for all of the value in the option because right now it's not worth anything. And so you can see pretty clearly then that there's going to be a relationship between option price and volatility. If I am an option holder, volatility is good because the more volatile the underlying stock is, the more chance that it's going to move in the direction that I want. Now, it could move in the direction that I don't want, but once again, I don't care about that so much because with an option, I'm not exposed to any of the downside risk. So if I'm an option holder, more volatility is better. And in turn, what that means is that the more volatile the underlying asset is, the higher the option price will be. If I look at this diagram, I can see that sort of the option price before maturity has two bounds. So the lower bound represents the exercise value. So this was the payoff diagram, say, for a call option. Now, an option that has not expired yet is worth a little bit more than an option that has expired because there's still the time value. There's still the possibility that the price could move some more. So the option that hasn't expired yet is going to be worth a little bit more than the option that has expired. The upper bound is that the value of the call option can't exceed the value of the stock. Why? Because fundamentally the call option is giving you the right to buy the stock. So the option can't ever be worth more than the underlying. So those are the two bounds for the option price. So what we can see with these two graphs here is the relationship between option price and volatility. You can see that in the bottom graph, where the distribution is a little bit wider, has higher variance, well, there's a higher chance of me ending up in the area where I can get a higher payoff. There's no downside to this because if the price ends up going really low, then I'm not going to suffer a loss anyway. So the more volatile the stock price is, the higher the option price will be. So when we think about options, we want to think about their role in constructing hedging portfolios. So the primary role of options is to try and mitigate some of the risk in the stock. So for example, let's say I want to buy a stock. I want to hold the underlying, but I want some downside protection. So how about this? I have a stock that, let's say, currently is worth 100. And, if the stock price goes up, I want to benefit from that. But I know that the stock will also go down. And so what I can do is, I can buy some put protection on it. How can I do that? Well, let's say that the maximum amount I'm willing to lose is 20. So I don't want to lose more than $20 a share. So what can I do? Well, I can buy a put option at a strike price of 80. So I can construct a portfolio where I buy a share of the stock and I buy a put option with a strike price of 80. If the stock price ends up above 80, then I can just sell the stock and I won't lose more than 20. But if the stock price ends up below 80, then I can exercise the put option and I'll be able to sell my shares for 80, even though the actual stock will be worth less. So this protects me from suffering too big of a loss. In this case, you can think about the option as sort of insurance. It limits the downside risk that I have to deal with. Of course, like all insurance policies, this is going to be costly, and the cost of this insurance would be the price of the put option. So let's think about what the payoff diagram would look like for this portfolio, this protective put strategy. Well, if I combine the underlying stock with the put option, if you look at the top right graph, well, what you can see is that this looks pretty much exactly like a call option payoff diagram. And in fact, I can achieve the same payoff diagram if I combine the call option with just putting money in the bank. So this is once again bringing us back to this principle that we've hit at again and again in this course, which is that we now have two portfolios that are supposedly different, but give us the same payoff, which means that there should be some relationship between the prices of all the assets involved in these portfolios. What we can show is that the price of call and put options, if they have the same strike price, are related by this thing called put-call parity. And what we're going to do is we're going to, once again, construct an arbitrage portfolio. So what we're going to do is we're going to long the stock. So we need to think about what happens now. With long the stock, we're going to pay the current stock price, and then in the future, we're going to get S big T. We're going to long the put option. So we have to pay PT today. Well, the payoff to the put option has two possibilities, right? Because either the stock price ends up above K or it ends up below K. So for the if I buy the stock, it doesn't matter. I get ST whether or not it ends up above or below K. But for the put option, this threshold matters. If the final stock price is above the strike price, I'm going to decline the option, so I get 0. But if the final stock price ends up below the strike price, I'm going to exercise the option. I'm going to get K minus ST. Now, on top of this option, I'm going to short one call option. So I'm going to receive CT today. And with a call option, the call option will be exercised if the stock price is above the strike price. However, I am the seller here, which means that I'm going to lose money. I'm being forced to sell this stock at a loss. If the stock price ends up below the strike price, the option holder will decline and I get 0. Finally, I'm going to borrow. And how much am I going to borrow? I'm going to borrow just enough so that I can withdraw, so that I have to pay back the strike price at time t. And let's add all of these columns up. So this column adds to 0. This column also adds to 0. So with this portfolio, I am guaranteed a payoff of 0 in the future. Which means that if I sum all of this stuff up, so this is going to give me CT plus K e to the minus R big T minus little t minus ST minus PT. If that is positive, then I have an arbitrage portfolio, right? Because I get a positive payoff today, no obligation in the future. If this expression is negative, well, then I can just reverse all of these positions, and then I have another arbitrage portfolio. So once again, I don't want that to happen. So what do I need? I need this thing to equal 0. So by this no arbitrage condition, I end up with the put-call parity equation, which is that CT minus PT is equal to S minus K e to the minus R big T minus little t. So if I have call and put options with the same strike price, the option prices are always going to be related through this identity. If this equality did not hold, then I have an arbitrage opportunity I can exploit by constructing the portfolio I showed in the last slide. So one neat feature of options is that by combining different options, I can generate all kinds of weird looking payoff diagrams. And why would I want to do this? Well, because I can generate whatever payoff structure I want and basically make whatever type of bet I want on where the stock price will end up. So for example, I may want to get a payoff diagram that looks something like this. So here I have basically two things going on. I'm limiting my downside risk, but I'm also capping my upside. So why would I want to limit my upside? Well, basically what I'm saying is, if I don't think the price is going to end up above here, so I'm willing to sell some of this upside in exchange for a premium. However, I also want to be protected if the price ends up below here. So in order to do this, what can I do? Well, I can utilize two call options. I want to buy the call option with the lower strike price, so I'm protected here. But then I want to sell the call option with the higher strike price. If the price ends up going above K2, well, I don't think that's going to happen. I'd rather just collect a premium for that. So using different types of options with different strike prices, I can construct all different types of payoff diagrams, and the shape of the payoff diagram sort of reflects where I think the stock price is going to end up. So with a payoff diagram like this, really what I'm saying is that I think the price is going to end up somewhere between here. So if I look at this diagram here, I have to go long on a call option with a strike price of 120, and then I short the call option with a strike price of 160. So my payoff is going to be between 0 and 40. If the price ends up below 120, both of these options will be declined, and then my payoff is 0. If the price ends up between 120 and 160, only this option will be exercised, so my payoff will be ST minus K1. But if the price ends up above 160, both these options will be exercised. So I have a long position in this option, I have a short position in this option, and my payoff will be K2 minus K1, which is going to be 40. So now we want to think about some techniques to price options. So option prices depend on 5 parameters. They depend on the stock price, the strike price, the time to maturity, the risk-free rate, and the volatility of the underlying. So these 4 parameters are directly observable. But this volatility parameter is not. Right? We can estimate a stock's volatility, but we don't know this for certain. So what this means is that there's going to be a direct relationship between the option price and the volatility, and we can think about the option price as being an indicator of how volatile the market perceives the underlying asset to be. Like we said before, options tend to be worth more when the underlying is more volatile, because you have a higher chance of ending up in the money, which means that the higher the option price, the higher the volatility should be. So let's start by looking at a simple 1-period option pricing model. So let's say the stock price right now is 100, and then next period, the price will either go up to 125 with probability P star, or it'll go down to 80 with probability 1 minus P star. So U, the uptick factor, is going to be 1.25, and the downtick factor is going to be 1 over U, or 0.8. So now let's think about a European call option with a strike price of 100. So let's look at what this option will be worth at maturity. Well, this is going to be worth ST minus K positive part. So what does that mean? Well, if the price is 125, I'm going to exercise the option. So I'm going to get a payoff of 25 with probability P star. If the price goes to 80, I'm going to decline the option. I'm going to get 0 with probability 1 minus P star. So this is the final payoff to the option. So I know what the final payoff to the option is. What I want to solve for is I want to solve for how much is the option worth today. So to do this, I'm going to construct kind of a weird portfolio. So I am going to go long 5/9 of a share of stock. And then I'm going to short one option. Okay, so this is going to be my portfolio. For every option that I write, I'm going to buy 5/9 of a share of stock. So what's my payoff going to be here? Well, in the up state, I'm going to get 5/9 times 125 minus 25, right? The stock will be worth 125, and then I'm selling this option, which has a value of 25 in the up state. So this is going to be about 44.4 repeating. In the down state, I'm going to get 5/9 times 80, and the option won't be worth anything. This is also, as it turns out, going to be the same number, 44.4 repeating. So what does this mean? This means that if I construct this exact portfolio, where I'm going long 5/9 a share of stock and I'm writing one option, I'm going to end up with a guaranteed payoff of 44.444. So let's take this a little bit further. Well, if this payoff gives me a guaranteed payoff, then it's risk-free, right? Now, if I have a risk-free portfolio, how should I discount the future payoff? Well, I should discount a risk-free portfolio by the risk-free rate. So let's say that R is equal to the log of 1.111. Just to make it like that, because I wanted to make e to the R equal to 1.111. And so how much is this portfolio going to be worth today? Well, this portfolio, if I discount it, is going to be worth 40. So investing in this portfolio is equivalent to putting $40 in the bank today. So if investing in this portfolio is equivalent to putting $40 in the bank today, so BC, that's how much I'll have to put in the bank to replicate this, is equal to 5/9 S naught minus C naught, right? The cost of this portfolio, so the cost of buying 5/9 of a share of stock and selling one call option should be equal to 40. Therefore, the call option should have a price today of 5/9 times S naught. S naught is 100 minus BC, the equivalent bank deposit, which is 40. So 5/9 times 100 minus 40, that's about 15.556. So by using this replicating portfolio, we have determined that the call option price today must be 15.556. If it were not, then of course there would be an arbitrage opportunity. Well, as you guys might be asking, well, where did I get that 5/9 from? That seemed to be an important number, because if I had exactly this many shares of stock for every option, I end up with a risk-free portfolio. So how did I know to choose this number 5/9? Well, if I want to think about the ratio, in the upstate, the option is worth 25, and in the downstate, it's worth 0. So the difference in the possible payoffs of the option is 25, whereas for the underlying stock, in the upstate, it's worth 125, and in the downstate, it's worth 80. So I have 25 over 40, or 5/9. This is what's called the option's delta. So the delta of an option is basically how much the option price changes with the price of the underlying stock. So in order to construct the portfolio that we had last time, we want to come up with a portfolio with a delta of 0. So I know the option has a delta of 5/9, and I know that the stock itself, by definition, has a delta of 1. Well, I can construct a delta neutral portfolio by buying delta C shares of stock for every option that I sell, right? So this thing has a delta of 5/9, and this also has a delta of 5/9, so the delta of this is going to be 0. So this is what we call a delta neutral portfolio. A delta neutral portfolio is going to give you the same payoff regardless of where the stock price ends up. And if that's the case, then you have a risk-free portfolio. And if you have a risk-free portfolio, the risk-free portfolio should always be discounted at the risk-free rate. So this is the final payoff to this delta neutral portfolio. And because it's delta neutral, we know it has a single value. In this case, it was 44.444. If we discount that at the risk-free rate, we end up with the initial cost of this portfolio, which was 40. And because we know the delta, we know the stock price, we can then solve for the option price. So that was for the call option. Well, what's the delta of the put option? If I have a put option with the same strike price, then, well, if the stock price ends up being 125, I'm going to decline the option and get a payoff of 0. If the stock price ends up being 80, I'm going to exercise the option and get a payoff of 20. So the delta for the put option is going to be 0 minus 20 over 125 minus 80, or minus 4/9. So the delta of the put option is going to be negative because, well, the higher the stock price goes, the less the put option will be worth. And so we can see pretty clearly that delta C, which was 5/9, minus delta P is equal to 1. Now, this clearly is not a coincidence. So once again, I can construct a delta neutral portfolio. Here, I'm going to long one put option, and I'm going to also go long on the stock. I'm going to buy 4/9 of a share of stock because I'm doing negative delta P, which is going to be plus 4/9. And so in the upstate, I'm going to get 4/9 times 125, or 55.556. In the downstate, I'm going to get 20 plus 4/9 times 80, which is going to be the same number. If I discount this thing at the risk-free rate, then I'm going to get 50. So P naught is going to be equal to 50 minus 4/9 times 100, which is approximately going to be 5.556. 50 is this thing times e to the minus r. So I can solve for the put option price with the same method. However, I also have another equation that lets me get the put option price once I have the call option price. Because if you remember, I had this equation, Ct minus Pt was equal to St minus K e to the r minus big T minus little t. So I can also get the put option price by saying, well, that's going to be equal to the call option price minus the stock price plus K e to the minus r. So it's going to be 15.556 minus 100 plus 100 times 0.9, which is going to give me the same number, 5.556. So I can, anytime I have solved for the call option price, I can also just apply the put-call parity equation to also get the put option price. I don't need to go through the same procedure again to get the put option price. So one curious thing that you may have noticed is that we managed to solve for the option prices P naught and C naught without ever having to use the true probability of the uptick. So that's a little bit weird, right? At no point did we have to think about, well, what's the likelihood that the stock price goes up or the likelihood that the stock price goes down? We were able to figure out what the price of the call and put options were without ever having to think about what the true probabilities were. And in fact, with option pricing, we pretty much never have to think about what the true distribution of future stock prices is. Now that's extremely odd, right? Because you would think that the distribution of future stock prices would be the most important thing. So what gives here? Well, what matters in option pricing is not the true probability that the price goes up and down, but rather the perceived probability from investors. And so what we're going to assume is that we're going to assume that all investors are risk neutral. Why are we assuming that all investors are risk neutral? Well, because it just simplifies the process and we end up at the same answer, okay? The assumption that investors are risk neutral doesn't mean that we actually believe everybody is risk neutral, because clearly they aren't. But we can use the risk neutral probabilities, risk neutral pricing, to find the option price, and it will be the same option price that we get no matter what type of risk attitude we assume. It's just that with risk neutral pricing, we can get to the same answer with fewer steps, which is what we like. So, what we want to think about is not the true probability. P star was the true probability. We want to think about P, which is the risk neutral probability. So how do we define the risk neutral probability? Well, if we think about what the stock price is today, the stock price should equal the expected value of the future discounted stock price. Now, if we assume that everybody is risk neutral, that means that they should discount everything at the same rate. And what rate should they discount? The risk-free rate. Well, what do we have here? What's the expected future discounted payoff? Well, with probability P, the stock price will go up. So S naught times U plus Well, with probability 1 minus P, the stock price will go down. S naught times D. And then we discount this whole thing by the risk-free rate. Now, if you look at this equation, all of these S naughts are going to cancel out. I'm going to end up with PU plus 1 minus P times D is equal to e to the R. That's going to give me a risk-neutral probability of P equals e to the R minus D over U minus D, which is approximately 0.691. So, what does that mean? Irrespective of what the true probability of an uptick is, if we treat the stock as if it was going to go up with probability 0.691, then we can price all of the assets, including the underlying stock as well as options, by treating this as the probability of an uptick and then discounting at the risk-free rate. So how is that going to work? Well, with a call option, the call option is going to pay off with probability P, because I get a payoff only in the up state. How much is it going to pay? It's going to pay S times U, 125, minus K, and then I got a discount, so it's going to be 0.691 times 25 times 0.9, which will give me, shockingly, the exact same answer I had before. For a put option, it's going to be 1 minus P times K minus S naught times D times e to the minus R, which once again will give me the same answer I had before. So, we know that these option prices are the ones that we arrived at by using the replicating portfolio. So, if we were to assume everybody was risk neutral, then P is the perceived probability of an uptick. If we then use this risk neutral probability to find the expected payoffs of the call option and the put option, and then discount everything at the risk-free rate, we end up with the same option prices that we got using the other technique. Okay, so why did we go through the trouble of introducing those risk-neutral probabilities and the risk-neutral pricing when the hedging portfolio gave us the same answer? Well, that's because if we want to go from a one-period model to a multi-period model, then it's a little bit easier to use those risk-neutral probabilities than using the hedging portfolio. So that type of procedure can be extended more easily to a multi-period model. So the multi-period or binomial option pricing model can be credited to Cox, Ross, and Rubenstein, so CRR. And so we're going to have an option that has n periods of length big T over n. All right, so we're going to divide the life of the option into a number of discrete steps. Each period, well, you can either have an uptick, U, or a downtick, D. And the size of the uptick is going to be related to the volatility of the underlying option. So U is going to be e to the sigma times the square root of delta t. So this is the volatility times the square root of the time. And then D is just going to be equal to 1 over U, or e to the minus sigma square root of delta t. So in our example, T is equal to 1, and N was equal to 1. So in the previous example, we had a one-period model. So the price just went up or down, and that was it. So what we really want to do is we want to back out these parameters. All right. So sigma is going to be equal to log of u, or log of 1.25, or approximately 0.223. And the risk-free rate was log of 1.11, or 0.105. So rather than saving u and this, we're going to save these two numbers. Okay, so we're going to have a volatility of 0.223 and a risk-free rate of 0.105. Combine that with the initial stock price of 100, strike price of 100, time is equal to 1. And what we're going to do now, we're going to keep these 5 parameters fixed. And these are the 5 parameters that determine the option price. And now we're going to think about changing n. Okay? We're going to think about, all right, we have this option with these parameters, and this is kind of a one-step approximation of what can happen. Either the price goes up or it's going to go down. But that's not really how stock prices move. They don't move in these big chunks like this, right? So we can get a better approximation by increasing the number of periods. We can get a finer approximation. So we can think about the stock price changing in 2 or 3 or 4 steps. So we're going to keep all 5 of these parameters fixed, but we're going to now have 3 steps, which means that each step, the time is going to move forward by 1/3. So we're going to think about this stock price moving in 3 discrete ticks. We have 1 period, we're going to have 2 periods, we're going to have 3 periods. So stock price starts at 100. However, we need to think about, well, how much is it going to go up by each period? Well, it can't go up to 125 and then go to 1.25 squared and so on, right? Each step is not going to be as big as in the 1 period model. So we're going to figure out the tick size by keeping these parameters the same. So u is going to be e to the sigma square root of delta t. So e to the sigma times the square root of 1/3, or about 1.1375. D is going to be about 0.8719. And we can also figure out the 1 period discount rate. It's going to be about 1.0357. What that means is that each period, the stock price is going to go up or down by about 13%. This will approximate the stock with the same parameters as the 1 period model, where it just goes up to 125 or goes down to 80. So in the second period, the stock price is either going to be 113.75 or 87.91. So if we continue filling out this graph, after 2 periods, if it goes up both times, it will go up to 129.39. If it goes up and then down, it'll be back down to 100 because u is equal to 1 over d. If it goes down and then up, it'll also be at 100. If it goes down twice, it'll be about 77.29. And then there's 4 possible final prices it can end up at. 147, 113, 87.9, or 67.94. So we have this tree which shows all the different values that the stock price can take over the life of this option, right? It can go up, down, down, or it can go down, down, up, or it can go down, up, up. All these different possibilities that are reflected in this tree. So One final thing we have to do before we start computing the option price is we have to figure out what the risk-neutral probability is. So the risk-neutral probability is going to be e to the r delta t minus d over u minus d. Now, if you remember, we calculated the risk-neutral probability in the one-period model to be about 0.691. However, the risk-neutral probability changes as you change the number of steps because u and d have changed, and so has the discount factor. In the three-period model, we get a risk-neutral probability of about 0.606. So we have this tree here, and what we're saying is, okay, we're going to price this option as if investors were risk neutral and believed that in each step there was about a 60% chance the price would go up and therefore about a 40% chance the price would go down. So what we have to do first is we have to figure out what the final payoffs to this option are. Well, if I have a strike price of 100 at this top node, here I can exercise the option for about 47. Here I can exercise the option for 13. Here I would decline the option, so it's not worth anything. And here, once again, I would decline the option, so it's not worth anything. So I know what the stock is worth at each one of these points. I know what the option is worth at the end points. Now I want to work backwards. So I want to ask, well, how much is the option going to be worth here? Now, here, the exercise value of the option is about 29, but that's not what the option is worth at this point, right? Because I'm not thinking about how much would the option be worth if I bought it and exercised it immediately. I want to think about how much is the option going to be worth here if I bought it here, let it mature, and then received whatever payoff I would get in the future. So here, the option price here would be given by P times 47.18 plus 1 minus P times 13.75, and then I discount all of this stuff at e to the minus r delta t. And so I'm going to repeat that procedure here. So I'm going to look at these prices. Here I'm going to look at these. So here the option would just be worth 0. And I'm going to use backward induction. I'm going to figure out what the prices were here, here, and here. Then I can use the price here and here to figure out the price here, and so on, until I am able to get back to the original option price. So to do this mathematically, let's let J be the period and I be the number of upticks, which means that J minus I is the number of downticks. So for example, S21 would mean that I have period 2, which means I have 2 ticks, one of which was an uptick, one of which was a downtick, so the price ends up back at 100. So in general, Sji is equal to S naught u to the I d to the j minus I. D to the j minus I is equal to u to the I minus j, because d is equal to 1 over u. So this is going to be equal to S naught u to the 2i minus j. And so I know the option payoffs only at the final period, right? So at period n, in this case at period 3, I know that the call option is going to be worth Sn I minus k, positive part, and then I can substitute for this. S naught U to the 2I minus N minus K positive part. And then I want to use backward induction. So once I know the call option payoffs in period N, I can then take one step back, figure out how much the option is worth in period N minus 1, and keep going back till I get back to the beginning. So the call option price is the expected value of the call option in the next period discounted by the risk-free rate. So CJI is equal to P of CJ plus 1. Okay, so I'm stepping forward the period by 1. Now, if I step forward the period by 1, I can either have an uptick. So if I have an uptick, both I and J will increase. Or I could have a downtick, in which case J would increase, but I would stay the same. And then I have e to the minus r delta t. And then I can apply this formula, work backwards toward the end to get back to the initial option price. So if I have S33, so this is when all three ticks are up, I get a stock price of 147. This means that the call option can be exercised for 47. S32 is 113.75. That means the call option can be exercised for 13.75. So I know C33 and C32, so I can calculate C22. It's going to be P times C33 plus 1 minus P times C32 times e to the minus r delta t, which in this case is about 32.84. Now, if you recall, S22 was about 129.39. So, what does that mean? That means the intrinsic value of the option at the node 22 is 29.29. If I were to buy the option here and exercise it immediately, it would be worth about 29. However, this undersells the value of the option, right? The option is actually worth about 32.8. I'm better off buying the option, holding it, and then exercising it at maturity rather than trying to exercise it right away. So, and this principle applies in general. So we talked a little bit at the beginning about American and European options. And while it might seem that American options are much better because you have the flexibility to exercise the option whenever you want, in fact, in the vast majority of circumstances, it's not a good idea to exercise the option early. You're much better off just holding it and letting it mature. Now, if you really just wanted to get rid of the option, you're in fact better off just selling the option rather than exercising it. You would get a better payoff from selling this option to somebody else and letting them hold it rather than exercising the option yourself. So this is sometimes called, an option is worth more alive than dead. So if you look in this diagram, this is what we get from applying the backward induction formula, right? So we can figure out that in node 2, so that's when it went up twice, that it was either going to be worth 47 or 13, and so we use that to figure out the option here would be worth 32.8. These bottom two is going to be 0. So then the option here would be worth about 8.04. Here would be worth 0 because it's guaranteed to be worth 0 in the future. I then go back again. I do P times 32 plus 1 minus P times 8. Discount out the risk-free rate. Find the option here is worth about 22. Option here is worth about 4.71. And then I apply the formula one last time, and then I get that the initial price of the option is about 14.83. Let's just think about what we did here, okay? We figured out what U and D were, and then we figured out how the stock price could evolve across this entire tree. Then, using the final stock prices, we figured out what the option payoffs were, and then we worked backwards. We used backward induction to figure out what the option price was in period 2, in period 1, and finally at the beginning. Okay, so just to remind you guys, we have kept these 5 parameters constant. And all we've done is vary the number of periods. So we have a finer approximation of how the stock price moves. So with 1 period, we calculated that the option price would be about 15.556. And with 3 periods, we got a price of about 14.831. Now we can increase the number of periods and get better and better approximations. For example, we had 5 periods, we get an option price of about 14.646. 10 periods, we'd get about 14.131. And what you can clearly see is that as we get a better and better approximation of how the stock price moves with more and more periods, the option price seems to be converging towards something. So if we take n to infinity, and we basically have a continuous time approximation, in the limit, we would get an option price of about 14.358. Now, you might be wondering, well, where does this number come from? So that number comes from one of the most famous equations in finance, which is the Black-Scholes option pricing formula. And it's probably more correctly referred to as the Merton-Black-Scholes formula, because Robert Merton also contributed to it, even though he doesn't seem to get much credit for it. And the Black-Scholes formula looks rather complicated. So I have a call option, which is a function of the underlying stock price and the time, which is going to be equal to S times ND1. So N here refers to the standard normal distribution function, and D1 is another expression which looks like this. So this, of course, is a pretty complicated looking expression, but we can kind of see all of the elements that we've been talking about throughout this lecture here, right? We have all these parameters. We have sigma, we have S, we have K, we have R, we have T. And if we look at these two terms, you can kind of think about a breakdown of the two things that we think about are important when it comes to the option price, right? We have something that relates to the ratio of S and K. So this captures the intrinsic value of the option, the relationship between the current stock price and the strike price. And then we have this other term which relates to the amount of time left until expiration. This term sort of reflects the time value, because we talked about part of the value of an option comes from the possibility that the price can continue to move between now and maturity. However, this isn't the whole pricing formula. We also have this second term, K e to the minus R big T minus little t. So the discounted value of the strike price times ND2. And D2 is another one of these expressions. which looks very similar to D1, except we have a minus sign here instead of a plus sign. And so we have this fairly complicated looking formula that tells us the price of a call option at any time and for any price of the underlying asset. Now, while this may not appear particularly elegant to you, the Black-Scholes formula is actually quite an achievement because, at least for European options, we have this closed form solution where we can just take these parameters, plug them into the Black-Scholes formula, and it'll tell us the option price. This is not something that is guaranteed. For example, if we were looking to price an American option, there's no similar equation that exists for American options. If we wanted to price an American option, we would have to do it numerically. So if this is the equation for the call option price, we can get the equation for the put option price just by applying put-call parity. So by put-call parity, we have that the put option price is equal to the call option price minus the stock price plus the discounted value of K. And what we get is that the put option is going to equal the discounted value of K times N of minus D2 minus S times N of minus D1. So this is the formula for the put option price. And once again, these formulas work specifically for European calls and puts. Put-call parity doesn't actually hold for American options because of the possibility of early exercise. So these formulas wouldn't work for American options. While this formula can be pretty difficult to interpret, there is some intuition that we can get out of it. Specifically, we can point out that this ND1 reflects the partial derivative of the option price with respect to the stock price. So how much does the option price change as the underlying stock price changes? If you guys recall, this is what we called delta. All right. So when we have a stock that moves in continuous time, maintaining a delta neutral portfolio isn't quite as straightforward as it was in the one period model because delta is not fixed. So I'm not able to just invest in a portfolio and be guaranteed that I won't be faced with any risk. If I'm dealing with a stock whose price is moving in continuous time, delta is also going to change because, as we saw, D1 changes with the stock price. And so I'm going to constantly have to rebalance the portfolio to keep it delta neutral. And delta is really only one of a class of different measures that measures the sensitivity of the option price to all these parameters that are relevant. So we have a couple of other ones. We have gamma. Gamma is the second derivative of the option price with respect to the stock price. So we can think about gamma as being the delta of delta. So gamma is saying how much does delta change as the stock price changes. We also have theta. Theta is how the option price changes over time. Remember we talked about this idea that part of the value of options comes from the time value, and the time value tends to decay over time because the possibility of the price moving more favorably is diminished as we get closer to maturity. We have rho, which is the sensitivity of the option price to the risk-free rate. And finally, we have vega. Vega is not actually a real Greek letter. It's just something that we made up. And we usually write this as kind of a blown up nu, you can think about it. And this is the sensitivity of the option price to volatility. And so this is just a few of the different Greeks that we can consider that reflect the sensitivity of the option price to all these different factors. There's plenty of other ones out there as well. So we talked about the fact that the option price is going to be a function of these 5 parameters, and that these were all observable, but volatility was not. So if we hold the observable parameters constant, then we can think about the option price as just being a function of the volatility. And we talked about this idea that when we're dealing with options, the higher the volatility is, the more the option should be worth. Because with an option, typically we're capturing all of the upside, but not the downside. So the more volatile the stock is, the more opportunities there are for me to make money. And while there may be a greater downside, I'm not exposed to it. So what we can think about, well, what if we inverted this function while keeping these other parameters constant? We're going to obtain what's called the implied volatility. So knowing the option price and knowing these parameters implies a degree of volatility for the underlying asset. And oftentimes you will see option prices quoted in terms of their implied volatilities, because many times that gives a more meaningful interpretation of what the option actually represents than the option price itself. Remember, when we're talking about derivatives, what we're really doing is we're turning some feature of the underlying asset, in this case it's the volatility, into an asset in its own right. So when I'm buying an option, what I'm really doing is I'm investing in the volatility of the underlying, right? If it turns out that the underlying stock is more volatile than the market believed, then the option will be worth more than what it currently is worth. All right, so that's the idea behind implied volatility.